The Bank of England is almost £200 billion underwater, and in its accounts from the last financial year, which is slightly different from the Bank of England if you're interested, it showed a loss of around £170 billion not yet realised on a number of its financial instruments. But how does that even happen? How does the Bank of England, the lender of last resort, make such huge losses? Well, it all starts back in 2009. So in 2009, chaos is the name of financial markets. Banks are falling over left, right and centre, emergency bailouts are going on all the time, and the UK government strikes up a deal to form a new company, and the new company is called the Bank of England Asset Purchase Fund Limited, and this company is set up purely to try and stabilise UK financial markets. Now, as a side note, I didn't realise that there was an SIC code for central banking, but it turns out there is, and because this is a privately limited company, the Bank of England Asset Purchase Fund, you can actually go on Companies House and see all the accounts. Now, we'll just say that this is no ordinary company, because when that deal was struck in 2009, there's one key feature of it that means that the Bank of England can take these massive losses and be completely fine with it. And that's that the Bank of England Asset Purchase Fund is backstopped by treasury. That means that any losses that are made are felt by the Treasury, and any profits that are made are shared between the Treasury and the bank. Now, that's all been fine so far, because since 2009, the Bank of England Asset Purchase Fund has actually transferred about £120 billion back to Treasury in the form of profits made on the assets that it purchased. But with interest rates rising, the roles have reversed now, and it's projected to lose £170 billion over the next decade on its assets. And the foot for that bill, because it's backstopped by the Treasury, falls on the Treasury, and ultimately that falls on the UK public. So how did this even happen, and what are the impacts on us as citizens of the UK? Well, now central banks are complex beasts, and I'm no central banker, so this is going to be quite a high level overview, and I'm sure there are many nuances buried beneath the surface that I'm not aware of, and probably most of us aren't. So since the financial crisis in 2008, the Bank of England has built up a war chest of around £640 billion in UK government debt, and that's as of the accounts published by the Bank of England Asset Purchase Fund. Now, there are a number of reasons why the bank might buy up this debt, but the most common one is that the UK government needs a sudden influx of money. So a great example of this is the pandemic, which happened a couple of years ago, when basically the government shut down the whole economy, but needed to keep paying people and keep things rolling, and so it needed a lot of money fast. Now, the trouble was, pretty much every other country was doing the same thing, and that meant that the public markets couldn't fund this sudden influx of debt. That meant that central banks across the world had to step in and buy government debt, so they exchanged effectively made up money for government debt, which is borrowing from your future self. Now, to understand where these losses are coming from, you need to have a quick crash course in how bonds work. So a bond is almost just like an IOU. So if the government needs to borrow some money, it could issue a bond. Bonds have a face value and a coupon value. So for example, the bond might have a £100 face value and a £5 coupon value. That means that every year, that bond will pay £5 to the holder of that bond until it matures. When it matures, the government will pay the investor the face value of that bond back. And so that means you can calculate a yield on these bonds. So in our example there, a £5 coupon on a £100 face value would be a 5% yielding bond. Now that gets a little bit tricky when the central banks increase interest rates. So as I'm sure you're well aware, that's been happening all over the world as central banks fight inflation. And to do that, one of the tools they have at their disposal is jacking up the interest rates. Well, why is that a problem? Well, commercial banks can hold reserves and deposits with the Bank of England, and that gets paid at the Bank of England base rate. And so as that's risen past the yield on government debt, it's made it much more attractive to just hold your money with a central bank than it has to buy government debt. And so the government, when it's issuing new debt, is having to make that debt more competitive with the Bank of England base rate. And that's resulted in yields rising on debt. And because the coupon value, which is that £5 in our example earlier, doesn't change, it means that the face value that that debt is being traded at has to change. And so if a bank buys up some UK government debt, it can sell that debt on, and it could sell it on for, say, £110 and make £10 on its face value if someone's willing to pay that. Likewise, if no one's willing to pay that, it might have to reduce the price. And that's what's happened here. As the Bank of England base rate has gone up, the government has effectively issued debt with a face value of, say, £100, but a coupon value of £10. So in that example, the yield is twice the amount that we had on the original bond yields that we were talking about. And so those original bonds, if they're floated on the market, would fall in price. Now, if they would fall in price to the same rate as the newly issued debt, then that would mean they would have to halve in price. So if that £100 face value paying £5 coupon was traded at £50, still issuing that £5 coupon, well then its yield is 10%, which is in line with that newer government debt that's being issued. Now those are all just made up numbers to try and illustrate the point, but I think it shows that how as interest rates rise, the value of bonds can fall. And it just so happens that most of the debt that the Bank of England holds is UK government gilts, which is a type of bond and a type of debt. And so as the Bank of England has raised interest rates, it's hurt its own asset purchase programme. And in the last financial year, that's been estimated at about £170 billion. So what is the bank going to do about this? Well, firstly, let's get this straight. The bank doesn't care if it makes a loss or a profit on its assets. Remember what I was talking about earlier in the video? About how when the Asset Purchase Programme Fund was set up, it's indemnified by HM Treasury. That means that any losses or profits flow back to the Treasury. And so any losses here that are being made don't really affect the bank. It's the Treasury and ultimately us as the UK taxpayers that have to foot the bill. Now there's a really good reason why this was indemnified. I know some people have argued that it shouldn't be indemnified and that we should take away that indemnity. But it's purely to stop there being any conflict of interest between the Bank of England and its large balance sheet. So for example, if the Bank of England knew that all of the assets that it held on its balance sheet were going to drop in value as it started to increase interest rates, do you think it would have been quite so excited to increase interest rates? Probably not if it knew it was going to shoot itself in the foot to almost £200 billion. But that might have been bad for the rest of the UK economy, as the interest rates were increased to try and fight inflation. And at the end of the day, the inflation is what we feel the most as consumers in the UK economy. Now when you talk about such large numbers like this, it can get a bit abstract quite quickly, so I just wanted to put that into context. So the Bank of England has suggested that there'll be £170 billion worth of losses that get realised over the next decade. So if we assume, just for simplicity, that those are realised equally across every year of the next decade, now it's unlikely that will happen, but let's just assume it is for a second, that's £17 billion per year of losses that the Treasury will have to foot the bill for. That's around 15% of what the UK spends on its education budget every year. And that's money I'm sure the Treasury would rather be spending on things other than reimbursing the Bank of England for losses on its assets. So how does this impact you? Well, we've known that this was probably going to be a problem for a little while. So in 2021, the Office for Budget Responsibility, or the OBR, released some data where it suggested that if interest rates started to rise, there could be losses that were realised by the Bank of England and as such, the Treasury. Now, the OBR, in its usual way of doing things, has made a couple of suggestions of what could be done about this. First, raising taxes to cover the shortfall. Second, cutting public spending, again to cover the shortfall. Now again, just to put that into context, that would require about a 3% rise in income tax for the basic rate and higher rates to cover the losses per year from the Bank of England's losses on its asset purchase programmes. But there are other ways, other than the losses on its debt, that the Bank of England can be impacting the UK's finances. Another big issue here is the fact that the Bank of England pays interests on the reserves that are held by commercial banks at the Bank of England. And so as part of the financial stability measures, the Bank of England requires commercial banks to hold a certain amount of cash with the central bank. Now, in return for doing that, the central bank will pay an interest rate on that cash held, so it's not just a complete tax on the commercial banks holding their money with the central bank. Now, at current interest rates, the amount of money that the Bank of England is paying on that interest is around £40 billion per year, so it's even more than potentially that the Bank of England has lost with its asset purchase programmes per year in cost to the Treasury. Now, just to put that £40 billion into context, that's about the same amount of money that the UK government receives in capital gains tax receipts in any given year. So it effectively wipes out any income that the government's got from that capital gains tax, just going straight to paying interest to commercial banks. So an obvious call that could be made here is that the Bank of England could stop paying interest on the reserves held by commercial banks. Now, I personally don't see this happening. It's obviously really attractive politically, because imagine if you're a politician here, you can basically free up £40 billion in cash that could be spent on infrastructure, it could be spent on schools, it could be spent on the NHS, or it could just halve the UK's deficit in the next financial year, which again is very attractive. But as with all things, there's no such thing as a free lunch, and someone somewhere is paying the money, and in this instance the money would be paid by the banks, so it would effectively be a tax on commercial banks. because they're forced to hold certain amounts of reserves with the central bank. And so if they're not being paid on that, there's an opportunity cost there for the money that they're having to park with the central bank that they could be lending out into the economy, stimulating small businesses, allowing people to purchase homes, and all those kind of things that can drive the economy. Now, obviously, this isn't an ideal situation for the UK. I can't really see a way out of this. I think the UK is just going to have to take the sort of 40 to 50 billion pound hit per year over the next few years. Now, if the Bank of England does start to reduce interest rates, which it is predicted to do over the next sort of 12 months, and we'll see where it settles in the long term, but that will reduce the amount of interest that's paid to commercial banks on these deposits. And it'll be interesting to see long term where this balances out, whether the Treasury still has to continue paying money to the Bank of England for these deposits held by commercial banks, or whether the central bank's day-to-day activities can cover the cost of this interest from its own activities. There's also the question of trust here. So the central bank relies a great deal on the trust of financial markets, and that means that it adds an extra tool to the central bank's arsenal of things that it can use to combat any destability in the financial markets. And that's because when the central bank comes out and says something, that can move markets as much as what it actually does. And so if the markets no longer trusted the central bank, then it loses that tool and that ability to influence markets with words rather than actions. And obviously words are a much cheaper way than buying lots of debt. Now, this also leads on to another quite interesting question. If you cast your mind back to earlier in this video when I was explaining how bonds work, you might have picked up on the fact that if you hold a bond to maturity, you get paid the face value of that bond. So in our example earlier, when our £100 bond fell to £50 so that its yield was the same as the newer debt that was being introduced, or if the person who originally bought that debt, even though the market rate dropped £50 when its face value is £100, if that entity held that debt through to maturity, they would get that face value paid back to them. And so this is how quantitative tightening is working at most central banks. So most central banks are just holding the debt and it will mature, and then they won't reinvest that money into new securities. But the Bank of England is taking a slightly different route, and that seems to be down, as far as I can tell, to lots of UK government debt being longer durated than many other governments around the world. And so that means that the Bank of England is actively selling down its debt before it matures, so selling that debt into the market. And it's been doing this now for a couple of years. So another call that some people are making is that maybe actually the Bank of England could slow down its quantitative tightening and just hold that debt until it matures, because then it doesn't actually realise the loss on that debt, because it knows that the government will be paying that back at face value when it matures. Now again, that sounds great in principle, but it means that the Bank of England's balance sheet would stay large for much longer. And the Bank of England, from what I can read in its research papers, suggests that that in itself could pose a financial stability risk to the economy. Because if something were to happen to the value of all the assets that the bank holds on its balance sheet, well, suddenly the Treasury foots the bill for that. And that could be massive deficits run by the government, as the Treasury has to refund the Bank of England for all these losses that it's making. And so it seems to be trying to wind down its balance sheet at as quick a pace as it can without causing any destability in the markets. Now, I can't really see a way out of this for the Treasury and the Bank of England. I think they're just going to have to take their hit here, sell off the assets as planned, and take the losses. Now, it is obviously really annoying politically for the new government that's come in, because they're a pro-growth government here trying to stimulate growth in the economy. And if there's 40 to 50 billion pounds having to be spent by the Treasury every year just to give to the Bank of England, which is effectively just giving it to commercial banks, that's money that I'm sure they would rather be spending elsewhere, trying to stimulate new house building, for example, or new infrastructure projects. I'd love to hear your thoughts on this as well. Do you think we should stop paying interest on deposits held by commercial banks, effectively introducing a new tax for commercial banks? Or do you think this would remove too much trust that there is in the Bank of England? Now, this is actually based on a piece of content that I wrote on my newsletter a couple of months back, before the election was announced and before we had the sort of last 4 to 6 weeks of chaos of electioneering. And if it's the kind of content that you think you'd be interested in, I'll leave links down in the description below to my newsletter where you can sign up. Now, in the meantime, YouTube thinks you'll enjoy watching this video. Now, I have no idea what video is about to be suggested to you, but I hope you enjoy it. And if you've enjoyed this video and learned something new, please hit the like button down below. It really helps small channels like mine grow. And in the meantime, I'll see you in the next video. Thanks very much for watching.